All right, thank you all for attending the institutional panel. I'd like to thank our panelists here today. We have, probably don't need a lot of introduction from a lot of this crowd, but we have Smirnova, Senior Portfolio Manager at Sprott Asset Management, John Case is a Portfolio Manager at Century, and Chris Beer, who's a VP and Senior Portfolio Manager at RBC Global Asset Management. And so thank you everybody for attending this. The theme of this and the direction that we're going with the panel today is talking about a new bull market for precious metals and how they're approaching it, and how they and how investors should look to approach it, and companies looking to raise money in it should approach it as well. So it's actually a bit of a discussion. So I have a few questions to start off, and then we'll turn it over to the audience and see what they have to say or ask questions about. Prefer you to ask for checks for the panelists at this forum, but leave that up to you. So just to start off and keep it simple to start. I mean, obviously we had Eric open up and talk about where he thought the market was going this morning, and that we're in a new bull market for precious metals. But maybe we'll start at the far end with you, Chris. And what do you think? Where do you think we're at in this cycle and what's happening?
Thanks, Derek. Hello, everyone. Well, I was here in February or so 2017, just after President Trump got in, and I thought, many of his protectionist policies would be positive for the gold price, and it wasn't that prescient. And in hindsight, the gold price has moved up, and the stocks have moved up in many cases better than the gold price. But obviously, it hasn't been a straight line. So I didn't catch Eric's presentation this morning, but I did get the closed notes version, and I agree with a lot of what he said. But I also thought, although Marie and I disagree a little bit on David Hartwell's presentation, but I do think you have to reach out to not non-believers, but like ESG is a big feature, and we'll get into that. But the World Gold Council, I actually forward one of his charts to the World Gold Council. They did a presentation in June, July, so I sent the link to some pension fund we're managing, and it's surprising. They were like, wow. So it is, I think to answer your question, we're early days into this bull market in gold. Clearly, interest rates are going to stay low for a fair amount of time, but we have an election coming up, so it's gold. It's going to be volatile.
Same question for you, Joe.
Yeah, no, for me, I think the really stark kind of change has kind of come in the last 4 or 5 years when you look at the correlation between interest rates and gold and how tightly correlated it is. So to be honest, I spend more time talking to the fixed income group internally at CI than I do to gold strategists to get a handle on where the world's going. And you certainly get this increasing concern, pessimism over the path of rates and really the ability of sort of to keep printing money and sort of the monetary authorities around the world to keep the game going, so to speak. And when I talk to our fixed income guys, they're all of the opinion that we see 1.5 on US 10 years before we see 2, which again is extremely bullish for gold. So I think given what our fixed income group is saying, and CI runs 120 billion AUM, 50 in equities, and the rest in fixed income. Even on the other teams within CI, there's just a general sort of expectation that the path of rates is lower and not higher, despite what you might hear in the media about U.S. growth and a lot of the Fed officials lately have been sort of trying to talk up inflation. It doesn't seem to be the fixed income markets is calling BS on that, and so I'm of the view that if that's the way we're going, then I think gold is going to continue to march higher.
Well, I work at Sprott, so you guys know where we stand. I think we do definitely listen to Eric, obviously, and what he says, and I agree with John, though. We watch real interest rates very, very closely, and the correlation with gold is uncanny, especially as of late. And the central banks are out of bullets, we think. The reason we had a false start in 2016 was because we didn't think that we'd go into Fed tightening, but we did. We had 2 years of interest rate rises. but now realizing they can't do it anymore. So a reversal in all those policies, ECB, the Fed, other central banks around the world realizing they are out of bullets, and we are in it for a longer time than people thought. Stimulating economies is getting harder and harder, and Eric talked about these things like entitlements growing, debt levels growing. All these things are becoming harder and harder for the system to digest. Hence, interest rates have to remain lower for longer, and that's a good thing for gold.
And presumably silver, since you're on a silver fund.
Do you want me to comment on silver? So yeah, if we're bullish on gold, we're definitely more bullish on silver. And the reason for that is, again, the market is just that much smaller. And I've always said that for silver, the marginal dollar that goes in, the investing dollar, makes all the difference. And it's very easy to push the silver price around, up and down. So in bear markets, it underperforms gold. In bull markets, it outperforms gold. And as little as a few months ago, people wrote silver off, right? The ratio went to 93, 94 to 1, and people said, that's it, silver is dead. Let's buy Bitcoin and cannabis. But, you know, again, we're already seeing a reversal of that. Because, again, that marginal dollar, the ETFs, the coins, India, that makes a difference. And even the trading on the COMEX, it makes a big difference in the price, and we do think that it'll continue that trend.
And then I guess sort of taking that thought process into account, and in particular for John and Chris, since you guys run general resource funds besides precious metals funds, is there anything that you're doing with your portfolios to sort of rebalance at the moment, or things that you're looking at a little bit differently?
On general resources, you know, it's tough. It's a binary call. If, you know, President Trump, President Xi can get together and make something happen, and there might be an amelioration in trade, but we don't see, you know, a huge win for either side. And that's kind of what's needed for, you know, the macro economics for commodities, you know, macro commodities to work. Oil, it actually looks pretty good in the latter part of 2020, but we have a lot of new supply coming on us from well, three or four big projects outside of U.S. Unconventional oil. So oil doesn't look all that great. So you know, the money is flowing into precious metals. Well, the little bit of money that's out there is flowing into precious metals, and not into macro commodities.
Yeah, no, I think what's going on in the energy sector is actually probably helps most of the people in this room from the metals and mining perspective, because there is quite a lot of capital that gets, you know, with its run as sort of generalist resource money around the world that has the opportunity to move in and out of energy or metals and mining, copper, base metals, and gold, and certainly notwithstanding what you see in the energy price, if you've been following energy equities, they continue to suffer outflows like which they haven't seen, which, you know, as a gold investor, we've seen for a long time, but the energy is just stuck in that, and there seems to be no end in sight. So I think that does, from an asset allocation standpoint, you see energy now sub 7% of the TSX, it's below metals and mining as a component of TSX, so we're seeing fund managers internally that, you know, when it was 30% of the TSX, they had to be there. There's too much benchmark risk. They had to have an Canada or a Suncor position. Now they don't. There's really no benchmark risk to be zero weight. Most generalist fund managers, I would say, they don't want to own cyclicals. They don't want to own energy or base metals, so they'll have a placeholder. They don't need to do that in energy anymore, so that continues to hit that space. So from a top-down view, from a resource fund, I think you'll see asset allocators within the resource sleeves continue to move money out of energy equities and into base metal materials, other parts of the resource landscape where they can generate some alpha. So I think that's a minor tailwind. But again, when the money is continuing to go out of resource funds generally, it's still somewhat of an anemic backdrop.
So good news, but with bad news. And then maybe just thinking about, because we have an audience here, a combination of retail investors and mining companies. So both looking for, one set looking for money and one group looking to allocate money. Maybe each of you, and we'll start with Maria here, each of you can talk about, you know, some of the characteristics you look for in mining companies that are sort of key elements, and some of the things that you I'll start with key elements that you look for as positives, and then we'll go the other way after.
Do you want me to talk more about the smaller companies or bigger companies? Exploration, production? Anyone?
Either one.
Okay, well, there's different, different categories of companies, and we look at them, obviously, and look for different things. But I'll start with exploration. Obviously, in exploration, we want to see big potential, and we want to see, quality of deposit potential. What is quality of deposit? There's tons of factors, as you know, and you got to look at each one, but to me, the biggest ones in prospectivity would be grade and size. Of course, it has to work in terms of infrastructure and metallurgy and all those things. But kind of, if you have a dream of, and one of the questions I ask is, how big can it get? The question I got from Eric, by the way. How big can it get, and then why? And then you drill down into it, why? And outside of that, of course, and you start looking at development, production, you look for a track record, you look for management teams that don't let you down. So when you say something, and a year from now, you kind of have to deliver. And over time, we learn who can deliver and who doesn't deliver. And then the third thing I would say for me is the big thing, the theme, I would say, is disclosure. More information for me is always better. Visuals, sections, maps. I want to see where the drill holes are. I want to see them, I want to see drill logs. I want to see lots of sections, So when I ask for things like that and people don't have them, that's kind of a red flag to me. When I go into a 43-101 and I don't see certain information, that's a red flag for me. When it comes to PEAs and feasibility studies, what we like to see is a year-by-year mine plan for the life of mine. Can't imagine how many projects don't show that. And I understand there's, it's tricky and there's trade-offs, but for me as an investor, the more I see, the more comfort it gives me.
I'm going to take this question a little bit differently and focus on something that's sort of probably different from what Chris and Maria will say. One thing that's increasingly important to us is liquidity. There are structural changes going on in the asset management business, and those structural changes are going to affect investors in the room and the companies in this room. The asset management business can fight off passive investing by doing two things. One, they can produce a product that's better, which, certainly there's big data and quantitative ways they can go about generating alpha, but largely the other way, which is the direction it's going, is by lowering costs. And lowering costs means they have to get bigger. And you've seen asset managers get gobbled up, and you've seen this constant march for scale in the asset management business. And what the byproduct of that is going to mean is that small cap investing is going to become harder and harder and harder to attract capital, because at CI they want to have a portfolio manager for every $1 billion of capital. So if you've got $1 billion of capital, you can write as much money into small cap investing as you want. It's very difficult to put enough capital to work to move the needle and to still create a product that is scalable and can get bigger. Because by definition, small cap investing is not really a scalable product. You crowd out opportunities pretty quickly with size. So as we march down this path, you're going to see just a lack of capital. We're already seeing it happen for really the people in this room that truly, I believe, are the only ones that really add value in the business, the exploration companies that go out and put risk capital to work and find new discoveries. But how do you attract that capital? I think it's going to be the question for everybody in this room on the company side. I think the answer is, the way we're going, you're going to have to be in an index. I think that's one of the things over the next 3-5 years. You're going to see large asset managers, institutional managers have caveats that unless you're in an index and have some sort of minimum liquidity, we can't invest in you. I think to stay relevant, if you're not an index, you got to find somebody else that's not indexed, and you got to get together until you've got the liquidity and size to be an index and attract that passive capital. The pendulum's going to swing too far at some point in time, and you've seen it already where the multiples on the large caps this year have exploded. It hasn't trickled down to the small caps. You've seen the multiples spread blow out. So I think for investors, there's an opportunity. But I don't think that opportunity, I don't think that trend has run its course yet. You've seen Brookfield Asset Management CEO coming out, I think earlier this year, saying that there's an incredible opportunity in small caps that's going to be presented by this swing towards passive. And all these companies that are orphaned are going to trade at depressed multiples, and there's going to be a huge opportunity. I think it's equally applicable in mining, but we're not there yet, and I think it's a mistake to sort of fight that trend. So I think for the companies, you want to get into NetX. For investors, I think you want to wait until this trend is sort of run its course, and I think that there'll be some fantastic opportunities and things that aren't in indexes. But for myself as an institutional investor, we can't fight that trend yet. We have to get on board or get left behind. So I think liquidity and index inclusion for us is increasingly important.
Yeah, I agree with John. That's certainly the phenomenon of active versus passive. It's at least 50-50 on the S&P 500, and who knows, well, I do know, but I don't really want to say what it is in precious metals. So you can't fight that trend, as John said. What it means is, for us as portfolio managers or retail investors is, you really have to sharpen the pencil or tune in your sight and use a rifle rather than a shotgun. And but that comes with a lot of, if half the market is not following what it used to, it leaves a lot of opportunity. But I refer to it as this incubation period of holding small cap stocks is becoming longer and longer. And so what can you do if we have these structural changes? If you can't replicate, as John mentioned, the market cap of a large cap, then replicate some of the best practices of large cap resource companies or best-in-class equities, such as when you set guidance, and guidance obviously in most of the exploration area is not going to be production or earnings, but set catalysts that you can meet and beat, and then when you come in to meet investors or present, have a scorecard or report card and say, and obviously we're going to go through a period where no one's going to care again, and but at least you have to keep that, that staying power, and the only way to do that is to have, a report card of what you've done with what you have. And I mean, maybe the next question is, the other structural element, as Dave Hartwell hit on, is ESG, and so I've actually had a chairman last week ask me what ESG meant, and it means environment, social, and government, by the way, but in any case, they actually did a great job, but he didn't know what it meant, because we always invested before, not on ESG, but as does the company have social license? So clearly, if you're kicked out of the village or the town, you don't have social license, but that's become broader and broader, and it's something that the small caps have to address. I don't want to see the next dollar spent. I'd rather see it in the ground, but it's something you also have to do.
Yeah, I think that's a fair point. That ESG and community social license work, it doesn't matter where you're going in the world. If you don't have it, and you have to do it start at an early stage. If you don't have it, your project doesn't get anywhere, or you make a mess for someone in the future who might potentially acquire you. So, which is what we hope most of our Explore Code developers end up doing. On that same side, I guess, I guess we start from the other end and start with you, Chris. Are there anything that, so we talked a little about things we'd like to see in companies. What are some things that we don't like to see, or things that immediately jump off the page that turn you off? Not necessarily throwing companies out of your office, but the things that right away you're not going to invest.
Well, I mean, Roscoe Apostle and others host annual presentations on generally great kills a project. That's like 80% of it. So again, I think just setting catalysts and meeting those catalysts. Like for example, West Africa, like a West African company should not come into my office without having a strong view on like politics. And I don't want to spend the whole day talking politics. All you have to do is, and there's several brokers that have charts, is look at West Africa. We've gone from 0 to 20 million ounces in 20 years, and just have that chart of showing the gold production, and despite 30 coups, most of them, not bloody, and political intrigue. The profit generation for West Africa has been strong. So start with that and have a plan to deal with the ESG or the soft issues, because you can get bogged down there, but you better have an answer.
Yeah, for me, it's oftentimes it's what's not presented is what I look for. So, there's a blogger, most people in the room probably read his blogs, and I think he had a comment, I forget how long ago, but I think it's quite on point, which is you gotta expect that when a press release or news is presented to you, it's oftentimes presented in the most positive light possible. So you gotta kind of have to keep digging and see what's not in there, what's not presented, and companies that come forward and are straightforward and look, we don't know what the metallurgy is, we don't have a great capping, and they'll put that in the press release. For me, that's important because it speaks to honesty, which I think is really, obviously, what we're in the business of doing is really based on trust. So if you've got a company that's not forthcoming with everything, what they know and what they don't know, especially, and they just tell you what you know, I think for me that's usually a turn off, and sort of I'm on to the next investment opportunity, because no one expects an exploration company 1 or 20 or 30 holes into a new prospect to have all the answers. But if they're not telling you what they don't know, it speaks to the trust factor. And then I think that's where there's been a lot of pitfalls in this industry, and we've certainly stepped on our share of landmines based on companies that haven't been forthcoming. So I'm usually looking for what's not being presented and questioning why when presented with an opportunity.
Well, we're all busy and we have limited time. Most of the time I will try to take a meeting. There's one thing I screen for before taking a meeting, and that's liquidity. And you've talked about, trading. We need to be able to sell our position. So if a stock is trading by appointment, that's one hard stop. Another hard stop for me sometimes is no drill results at all, so lack of information. It's just too early in the stage. I need to see some kind of, the truth machine has to speak somewhat before I take a meeting, because I love great theories and beautiful plans with beautiful colors, but sometimes that's not enough. And then I've already talked about, the more data, the better, and that would be my biggest kind of criteria for more disclosure is good.
That fits right in with what John said, and that what you're not telling you is concerning, and sometimes it's intentional and sometimes it's not, and it's just you have that information, you're just not presenting it properly. We've got about 12 minutes left in the panel, so I think what we'll do now is we'll open it up to questions. So if you have a question, raise your hand, and Hayden here will run a mic out to you.
Yes, thank you. Yes, I got a question, Mike. How come these gold stocks, since gold has gone up so much, don't pay any kind of dividend? And now you also mentioned energy stocks. And IP Energy is terrible. But there's about a dozen energy stocks that are paying almost 10% dividend. Now, what's wrong with the gold companies? How come they aren't paying a dividend? The price of gold going up.
That's a good question. Actually, twice today I had to run out to see Total. So they have a market cap of 250 billion, and Equinor also probably 150 billion. Both those companies have dividend yields in 6 to 7%. They're buying back $1.5 billion, $2 billion worth of shares each year. And the South African gold companies obviously used to pay a big dividend and maintain their valuation despite the volatility of the gold price. They still went up and down with the gold price, but not like we see today. Derek had a few other questions there that he was going to ask, and one of them was, are the seniors and intermediates have discipline, and they're getting that. And certainly the mid caps are there, but again, the mid caps with the active passive phenomena are not fully embraced by the generalist market, but I do think it promotes better capital allocation if the company is paying out dividends. And it does look like the vast majority of companies now are in a position to pay a better dividend and demonstrate, more discipline.
Can I just add? Yeah, so the price of gold at 1,500, north of 1,500 is relatively new, and it really hit in Q3. So the last 3 months, we've averaged over 1,500, right, or something like that. So I think with that, it'll help the company start generating the free cash flow necessary to pay dividends. But also, let's not forget that in the last 7 or so years, we've had a cycle of underinvestment in exploration and underinvestment in capital. And I think companies will also restart spending some of that capital to find ounces and to build new projects. So I wouldn't count on huge dividends coming our way.
I don't have much to add to that. I'd say, the gold, like as Maria said, we haven't been there very long, and the gold companies have, I probably, the reporting is misleading in terms of the profitability of the industry. Like the industry is quite sick at $1,300 gold. No one was really making money. Mines are washing their face. There wasn't a lot. There isn't the returns to pay dividends at $1,300, and we've only been at $1,500 for a few months. I think what will be actually very important for the sector is the reporting period that was ending, I guess, on Monday or Tuesday, right, with the third quarter, because there is quite a number of passive funds that are sort of, let's call it, smart beta and quantitative strategies out there looking for earnings revisions, cash flow momentum. And Q3 will be a huge step change. Like almost everybody in the industry better make earnings and cash flow and free cash flow in Q3, and you're gonna see a huge delta from where they were in Q2. So it's going to be interesting to see how that pool of capital that looks for those type of changes react, and whether or not that's a real turning point in momentum for gold stocks. So I agree, they haven't reacted yet, but I think let's wait till end of October and get through reporting, and then let's see what the reaction is.
Next question. Don't all of you hold your breath at the same time. I do want to ask that question that we talked about, the discipline. So I was in a fund manager's office in London, and he point blank asked me, he said, do you think the seniors will be disciplined on M&A in this next bull cycle? The senior gold companies will be disciplined on M&A in this next bull cycle. I'm going to save my answer for the end, but I want to hear what you guys think.
Well, I think there's fewer senior companies now. We lost 2, right? And I think the answer is depends. Depends what company you're talking about. Some leaders of some gold companies are more disciplined than others. For example, I have a lot of respect for Mark Bristow, and I don't think he's going to do anything silly, right? I actually think him doing the big deal, is very smart on many levels. But anyway, in terms of general comments, my answer would be it depends on the company. And I think some companies will do better than others. My advice to companies is always, do acquisitions that are more incremental rather than transformative. Don't try to be a hero. Don't blow your brains out. That's pretty much my advice. To me, the acquisitions on the smaller scale are usually the smarter ones. Be it land around your own property in proximity to your mine. That's what makes more sense to me rather than buying, coming from one continent to another continent and buying a big company.
Well, again, coming back to this passive dynamic, just recently at the Denver Gold Show, you could see Barrick, we're going to hit the higher end of our production range, the lower end of our cash cost range. And so if I was, running any company, you got, especially the larger caps that are in indices, just game theory suggests that they should be setting themselves up. Because, as mentioned, we're not the incremental buyer. The incremental buyer is an index fund, and they're driven by, what comes across when the company reports. And if they beat by 5%, then, it's going to take a while, but you know, the robots will play that for a period of time.
I think the seniors, I mean, at the end of the day, and this happens every cycle, this is a depleting industry. So that they have to. I mean, Barrick, you know, is probably one of the few seniors that probably have, like, if you look at their production profile, this is a consensus, not me. You just go to whatever your financial software. I mean, they're X growth and they're dropping 10% over the next 2 years. I think that they have found some discipline and religion about the fact that it's growing cash flow, not growing production. So if you can cut costs as quickly as you can, you can keep cash flow steady if you can cut costs at the same rate that your production is dropping. But the problem that this business has is that the fixed costs are so high. There's huge cash flow leverage there. Like, your revenue drops by 5–10%, and there's not much you can do. It's gonna have a multiple effect on your cash flow. So yeah, I think ultimately some of the seniors, you know, more the ones that have, you know, challenged growth profiles, they can't find deposits. You know, I think Bristo's talking about 4 Mile, you know, it's 1 million ounces. Okay, well, Barrick's a $30 billion company that produces 6 or 7 million ounces a year. And doesn't move the needle, right? So, no, I think the seniors ultimately still have to have M&A strategies. You know, I think what's going to be really telling is going to be more discipline on the price and the type of acquisitions they do this cycle. But I think without a doubt that they're in the acquisition game. I mean, it's the business of the seniors when you're producing that much gold.
My answer was more in line with John's, and I think as small cap investors, that's what you hope for, is that they're not necessarily going to be, they'll be hopefully better than they were the last time around, so it keeps people in the space. But yeah, they are going to buy things.
Yeah, again, though, if you can sharpen the pencil or have a good shot, I mean, the big winners in the last 3 or 4 years, you know, I guess, yeah, sure, Barrick relative to something, but no, I just mean, like, yeah, it's done well now. Newmont was incrementally doing very well up until you know, they took and are trying to digest Goldcorp, but the Kirklands, K92s, the Wesdomes, you know, if you can bootstrap yourself up, and as Maria mentioned, like, that usually means you got to have some infrastructure. Or if you don't have infrastructure, it better be, you know, a very, very good deposit. I guess that would be kind of my concluding thoughts.
All right, we have time for maybe one more quick question. All right, you know what? It's a couple minutes early, and I'm sure Seb has the power to open the bar a couple minutes early, so I think we'll leave it there. Thank you again to all our panelists, and thank you everybody for sticking around for this.